The blip on the radar is barely noticeable amidst the chaos of global shipping lanes. It's a Suezmax tanker, heavy with 1 million barrels of Murray 16 crude, silently departing the Jose terminal in Venezuela. According to the headline scrolling on your phone, this country is a pariah, crushed under the weight of maximum pressure sanctions. The official narrative says the valve is closed, but zoom in on the bill of lading. The destination isn't Beijing or Havana, it's Pascagoula, Mississippi, and the consignee isn't a shadow fleet operator, it's an American energy giant. While the Federal Reserve raises rates to crush the economy and fight inflation, a secret backdoor has been opened in the Caribbean. They aren't just importing oil, they are importing price stability. They are effectively laundering a geopolitical enemy's resource to keep your grocery bill from causing a riot. The Strategic Petroleum Reserve is empty, but the shadow reserve is wide open. This isn't a diplomatic thaw. This is an economic hostage exchange, and the ransom is being paid with the integrity of the free market. Look at the radar again. That ship isn't just carrying crude. It's carrying the artificial life support for the US dollar. Turn off the TV and look at the geological map of the Texas and Louisiana coastline, where the supposed safety deposit box of the American economy is buried. That is the Strategic Petroleum Reserve, or SPR, where hundreds of millions of barrels of crude are pumped into massive salt caverns deep underground to insulate the United States from global energy shocks. For 4 decades, that inventory number was the most boring statistic in finance because it was always full acting as an impenetrable shield. But now, if you look at the latest data chart, you will see a vertical line dropping straight into the abyss. From a peak of over 600 million barrels, this reserve has been gutted to under 350 million barrels, which is the lowest level we have seen since 1983. To put that in perspective, the U.S. burns through about 20 million barrels of oil every single day, which means the shield protecting the world's largest economy is now alarmingly thin. And if a real war breaks out in the Middle East, choking off the Strait of Hormuz, America is effectively naked against the price storm. The official line from Washington is that they drained the caverns to stabilize gas prices for working families. But you need to think like a commodities trader for a second. You never liquidate your hedge unless you have already secured a cheaper and more secretive replacement supply. That is the moment we need to look out at the ocean where the ghost ships are docking. While the mainstream press is still broadcasting headlines about maximum pressure sanctions on Venezuela, the maritime traffic data tells a completely different story. Following the issuance of General License 44 by the Office of Foreign Assets Control, or OFAC, we witnessed a spectacular reversal in energy flows. From absolute zero, the volume of crude oil imports from Venezuela into the U.S. has spiked to between 150,000 and 200,000 barrels per day. Massive tankers that used to turn off their transponders to smuggle oil to China are now keeping their radar on and sailing directly into the Gulf of Mexico under the full protection of U.S. law. This is hypocrisy at a macro level, where we condemn a dictatorship by day, but quietly funnel cash to them by night in exchange for energy. Most people will choose to ignore these contradictions because the truth is often uncomfortable. But if you belong to the minority that is committed to looking directly at the brutal mechanics of the market, rather than seeking false comfort, hit that subscribe button right now to join us as we peel back the layers of narrative constructed by the media, because we are about to enter deep water where economic decisions are not based on morality, but on survival. Returning to the core problem, you have to ask yourself why the United States would debase itself like this. After all, hasn't America become the #1 shale oil producer in the world? Aren't we swimming in oil? That is a conceptual trick that the crowd falls for every time. Oil is not just oil. It is chemistry. The US produces a staggering amount of oil, but the vast majority of it is shale oil, which is light and sweet with low sulfur content. However, the complex refinery infrastructure worth billions of dollars lining the Gulf Coast was designed in the 90s to process heavy, sour crude, which is thick, viscous, and full of impurities. If you feed light oil into these specific heavy refineries, they operate inefficiently, which is like trying to run a diesel truck on jet fuel. American refineries are starving for heavy crude to produce diesel, which is the lifeblood of the trucking industry and agriculture. It is a cruel twist of fate that the nation holding the world's largest reserves of that specific heavy oil is the enemy in our backyard named Venezuela. So the paradox here is not an energy shortage, but a structural mismatch that forces Washington to sell out its diplomatic principles to save the domestic energy CPI. They are not just importing oil, they are importing stability for the dollar. But to legitimize this flow without triggering public outrage, Washington had to engineer a highly sophisticated financial mechanism called License 44, which looks like humanitarian relief on paper, but is actually a modern-day economic indentured servitude contract. And to understand who really holds the leash in this deal, we need to dissect the fine print of that document. To understand the architecture of this deal, we have to stop looking at it as a diplomatic breakthrough and start looking at it as a schematic diagram of a failing hydraulic system where the pressure is building up to a critical point, and the engineers are desperately installing a bypass pipe to prevent an explosion. This bypass pipe is what we call the gray channel, and its blueprint is hidden in plain sight within the dense legal text of General License 44, issued by the US Treasury Department. If you strip away the bureaucratic language about democracy and fair elections, you will find a very specific clause that transforms this from a standard trade agreement into a closed-loop debt recovery mechanism. The license does not allow the Venezuelan regime to receive cash payments in US dollars, which would violate the core tenets of the sanctions policy, but instead, it explicitly authorizes American corporations like Chevron to lift oil from Venezuelan ports for the sole purpose of debt repayment. This is a crucial distinction that most analysts miss because it changes the nature of the transaction entirely. We are not buying oil from a sovereign nation. We are seizing collateral from a distressed asset. It is a state-sponsored repo operation where the commodity is extracted to settle outstanding balance sheets rather than to generate revenue for Caracas. And this structure was designed specifically to bypass the global banking system so that the oil could flow without triggering the financial alarms that usually accompany dealings with a sanctioned entity. But the financial legalities are just the software that runs this system. The hardware is where the real desperation lies. To see the physical reality of this crisis, we have to zoom in on the complex refinery infrastructure lining the Gulf of Mexico, particularly facilities like Pascagoula in Mississippi, or the massive Valero plants in Texas. These are not simple kettles, boiling oil. They are multi-billion-dollar chemical cities designed with a very specific calibration. In the 1990s and early 2000s, American engineers bet heavily on the import of heavy, sour crude, investing billions in upgrading their coking units and desulfurization capacity to process thick sludge like crude, which has a low API gravity and high sulfur content. This was a logical bet at the time because heavy oil was cheap and abundant from neighbors like Mexico and Venezuela. However, the shale revolution in the Permian Basin flooded the market with the exact opposite product, which is light sweet, crude a substance so thin and volatile, it is almost like gasoline right out of the ground. While the media celebrated energy independence, the refinery engineers were quietly panicking because you cannot run a heavy crude refinery at full capacity using only light oil. It is a molecular mismatch that causes the equipment to run inefficiently, and more importantly, it fails to produce the one output that the industrial economy cannot survive, without which is diesel. Diesel is the blood of the supply chain because ships, trucks, and trains do not run on batteries, or ethanol, they run on diesel. The molecular structure of heavy Venezuelan crude is rich in the long hydrocarbon chains necessary to distill high volumes of diesel and jet fuel, whereas light shale oil yields mostly gasoline and naphtha. This chemical reality creates a terrifying bottleneck, where the US can be drowning in light oil but starving for diesel, and when the supply of heavy crude from Russia was cut off due to the war, and Mexico slashed its exports to feed its own domestic refineries, the American system hit a wall. This is the anatomy of the refinery addiction. The reliance on Venezuelan Maré 16 crude is not a preference. It is a hardware requirement. Without this specific grade of oil feeding into the coking units, the yield of diesel drops, driving up logistics costs for every single product on the shelf, from groceries to construction materials. Therefore, when you see a tanker docking in Mississippi, you are not just seeing a ship. You are seeing the injection of a chemical stabilizer into the U.S. inflation metrics. This leads us to the third layer of this gray channel, which is the inflation anchor. The Federal Reserve can raise interest rates to destroy demand, but they cannot print heavy crude molecules to fix the supply side of the equation. Washington knows that if the price of diesel spikes, it feeds directly into the consumer price index, creating a feedback loop that no amount of monetary policy can control. By quietly opening the valve to Venezuela, they're creating an artificial supply buffer, a shadow reserve that operates outside the quota restrictions of OPEC. When Saudi Arabia and Russia coordinate to cut production and squeeze the West, the U.S. responds not by drilling more shale, which takes months and does not solve the heavy oil deficit, but by widening the aperture of License 44. It is a geopolitical counterweight, where the oil of an enemy is used to neutralize the weaponization of energy by other enemies. This explains why the administration is willing to endure the political embarrassment of dealing with Maduro, because the alternative is a diesel crisis that would shatter the fragile illusion of economic recovery. The media sells this as a humanitarian gesture or a step towards free elections to keep the public distracted with a moral narrative, but under the hood, it is purely a function of thermodynamic and economic survival. However, this engineering fix has a fatal flaw because it relies on a supply chain that is deteriorating rapidly. The infrastructure of the Venezuelan oil industry, after years of neglect and mismanagement, is rusted and prone to catastrophic failure, meaning that the U.S. economy is now hitching its inflation stability to a braking machine. We have routed the critical coolant line of our economic engine through a territory we do not control, and entrusted the stability of our currency to a gray market channel that could be shut down by a single political decision or a technical breakdown at the wellhead. The system is operating on borrowed time and borrowed oil, masking the structural insolvency of the energy grid with a temporary patch that is leaking from the moment it was installed. This is not a sustainable equilibrium. It is a state of suspended collapse, where the physical reality of the hardware is fundamentally incompatible with the financial narratives being projected on the screens. We have built a machine that requires a fuel we no longer control, And now we are watching the pressure gauges redline, while the operators tell us everything is normal. But the vibration in the pipes tells a different story. And if you listen closely to the flow of capital, you can hear the sound of a system that is already broken from the inside. And no amount of surface-level intervention can reverse the physics of this decline. Now let us pull up the schematics and look at the telemetry of this machine, because while politicians speak in vague platitudes, the market speaks in precise spreads and differentials. If you want to understand why the gray channel exists, you do not look at the State Department press briefings. You look at the heavy crude discount chart, specifically the price spread between Mexican Maya and Venezuelan Maray 16. For a refinery engineer in Pascagoula, this spread is the only variable that matters. Mexican oil has historically been the primary feedstock for Gulf Coast refineries, but as Mexico's production declines, the official selling price, or OSP, of Maya has crept up, narrowing the profit margin for American refiners. This is where the Venezuelan arbitrage comes into play. Maray 16 is chemically almost identical to Maya, but because of the political risk premium attached to the Maduro regime, it trades at a massive discount to Brent, sometimes as much as $20 to $30 per barrel. When Chevron or Valero processes a barrel of Mexican oil, the profit margin is razor thin. But when they process a barrel of Venezuelan oil obtained through this special license, the crack spread, which is the difference between the cost of crude and the selling price of the refined products, explodes. This is not just trading. This is thermodynamic arbitrage. The system is designed to hunt for the cheapest molecules that can yield the highest caloric output. And right now, the most efficient fuel for the American economic engine is legally sanctioned contraband. This financial incentive is so powerful that it overrides every diplomatic red line that Washington has drawn in the sand. To prove that this is not just theoretical speculation, we need to look at the physical layer of the logistics network. Turn your attention to the satellite tracking data of the Caribbean sea lanes over the last 90 days. Historically, under the strict sanctions regime, the tanker fleet moving Venezuelan oil was what we call the dark fleet, consisting of old, rusted vessels with disabled transponders engaging in ship-to-ship transfers in the middle of the ocean to obscure the origin of the crude, before heading to independent teapots in Shandong, China. That was the old circuit. Today, the pattern has completely inverted. We are seeing major Suezmax class vessels owned by respectable Western shipping conglomerates loading directly at the Jose terminal and steaming north in a straight line towards the Gulf of Mexico. We have tracked specific vessels like the Caribbean Voyager or the Eagle San Antonio openly declaring their destination as Pascagoula or Corpus Christi. These ships are not hiding in the shadows anymore. They are operating in broad daylight because they are now part of the sanctioned machinery. The Gray Channel has been formalized. It is no longer a smuggling route. It is a critical artery of the U.S. energy grid. This brings us to a moment of harsh realization about how the world actually works versus how you are told it works. We are told that we are punishing a dictatorship for its human rights abuses, yet here we are watching the most sophisticated industrial complex in the free world become dependent on that very dictatorship to keep the price of diesel from crushing the American middle class. This contradiction leads us to a binary choice, and I want you to weigh in on this right now. Go down to the comments section and play the role of the judge. I want you to type just one word based on what you have seen so far. Type the word engineering. If you believe this is a necessary evil, a brilliant, pragmatic move to keep the economy running at any cost. Or type the word hypocrisy if you believe this system is morally bankrupt and that we are financing the very monsters we claim to fight. Don't write a paragraph, just pick your side engineering, or hypocrisy, and let the community see where the consensus lies, because this next piece of data might change your vote. The final component of this gray channel anatomy is perhaps the most cynical of all, and it is what we call the debt hole. If you look at the balance sheet of PDVSA, the Venezuelan state oil company, you will see a massive crater of unpaid obligations owed to American oil majors and bondholders. The genius of General License 44 is that it effectively turns the U.S. oil imports into a debt collection mechanism. A significant portion of the revenue generated from this oil does not go back to Caracas in the form of cash that Maduro can spend on his military or social programs. Instead, the value of that oil is deducted from the outstanding debt that Venezuela owes to companies like Chevron. It is a debt for oil swap. In accounting terms, this is a masterpiece. The U.S. gets the physical commodity it desperately needs to fight inflation, and the U.S. corporations get to recoup their stranded assets that were previously written off as zero. The only entity that technically gets nothing in terms of immediate cash flow is the Venezuelan people. But the regime accepts this deal because it clears their ledger and keeps the pumps running, preventing the total collapse of their infrastructure. We are not buying their oil. We are repossessing it one barrel at a time. The Gray Channel is essentially a liquidation court operating at sea, where the collateral is seized to make Wall Street whole, while the American consumer unknowingly burns the evidence in their gas tanks. This mechanical extraction of value solves the immediate problem for Washington, but it creates a dangerous blindness. While American engineers are busy fixing the pressure gauges in the Gulf of Mexico, they are failing to notice that the entire geopolitical foundation upon which this pipeline rests is shifting. We are so focused on the flow of oil that we have missed the movement of the tectonic plates beneath us, because on the other side of the world, a rival bloc is watching this desperation, and they are preparing a counter-move that involves more than just oil. If we zoom out from the specific valve clusters in Pascagoula and look at the global schematic of energy flows, it becomes immediately apparent that this gray channel was not constructed in a vacuum. It was built as an emergency bypass circuit in response to a deliberate siege on the American economy. While American engineers were busy retrofitting their refineries to accept Venezuelan crude, a much larger hydraulic press was being activated across the Atlantic. The decisions made by OPEC, plus led by Saudi Arabia and Russia, to cut production quotas are not merely business decisions to balance the market. They are calculated stress tests designed to fracture the Western financial system. Think of the global oil market as a single pressurized vessel. When Riyadh and Moscow tighten the supply screws, they are effectively trying to spike the pressure inside the U.S. economy to force the Federal Reserve to keep interest rates higher for longer. They know that if energy inflation reignites, the U.S. central bank cannot pivot to cut rates, and if rates stay high, the banking sector, which is already sitting on unrealized losses, will face a liquidity crisis. This is a form of financial warfare where barrels of oil are used as leverage to break the bond market. In this context, the sudden rehabilitation of Venezuela is not a diplomatic olive branch. It is a defensive countermeasure. Washington is using the Venezuelan flow as a pressure relief valve to neutralize the torque being applied by the Saudis. By bringing 50 million barrels of heavy crude back into the system under U.S. control, they are attempting to dampen the shock waves coming from the Middle East. It is a game of hydraulic chess, where the U.S. is using a pawn to block a checkmate from the king and queen of the energy world. But in a closed-loop system like the global economy, you cannot simply redirect a massive river of oil without drying up the delta somewhere else. And this brings us to the most ironic twist of this engineering marvel, which is the displacement of China. For years, the independent teapots or small refineries in Shandong province thrived on a diet of cheap sanctioned oil. Because Venezuela could not sell to the West, they sold to China at steep discounts, often accepting payment in yuan or goods. This cheap energy was a subsidy for Chinese manufacturing, allowing them to keep the cost of production low, even as wages rose. However, the Gray Channel has physically reversed this polarity. The tankers that used to sail east are now sailing north. The U.S. is effectively seizing the discount that China used to enjoy. By legalizing these cargoes for American entities, Washington has outbid Beijing not with money, but with legitimacy. The result is that Chinese refiners are now forced to scramble for replacement barrels on the open market, competing with Europe for non-sanctioned oil, which drives up their input costs. And here is where the feedback loop hits your wallet. If the factory of the world pays more for energy, the cost of producing everything from your iPhone to your kitchen appliances goes up. China exports this cost inflation right back to the United States. So while the Gray Channel might suppress the price of gas at the pump in Ohio, it simultaneously inflates the price of goods on the shelves at Walmart. We are squeezing the balloon at one end, only to watch it bulge at the other. It proves that there is no such thing as a free lunch in thermodynamics. You are simply trading domestic energy, inflation for imported goods, inflation. Furthermore, this operation reveals the terrifying reality of the currency architecture that underpins this entire precarious structure. We hear endless rhetoric about the death of the dollar and the rise of the BRICS alliance. We hear speeches from Caracas and Moscow about building a new financial order independent of Western hegemony. Yet look at the mechanics of General License 44. When the rubber meets the road, or rather, when the crude meets the tanker, the transaction is ultimately denominated in the power of the U.S. financial system. Venezuela, a loud proponent of de-dollarization, is accepting a deal where their most valuable resource is used to pay off debts denominated in U.S. dollars to U.S. corporations. They are not asking for gold. They are not asking for Bitcoin. They are asking for their debt ledger to be cleared in the imperial currency they claim to despise. This proves that despite the noise, the SWIFT system and the dollar-denominated debt markets are still the operating system of the planet. The U.S. has effectively weaponized its own debt, using the obligations owed to its companies as a leash to control the resource output of a sovereign nation. It is a demonstration of brute financial force that goes far beyond military capability. However, this display of dominance comes at a terrible cost. By bending the rules of sanctions to suit its own immediate needs, the U.S. has signaled to the world that its moral stance is fluid and transactional. We have told our allies and our enemies alike that our principles are for sale if the price of diesel gets too high. This erodes the trust that is the true reserve currency of any superpower. We have built a geopolitical web that is held together not by shared values, but by a desperate need to keep the lights on and the prices down before the next election cycle. The Gray Channel is currently holding the line, keeping the pressure gauge just below the red zone, but the vibration in the pipes is getting stronger. We have linked our economic stability to a decaying infrastructure in a volatile state, and we have angered the titans of the oil world who are watching this bypass operation with growing impatience. The temporary fix is working for now, but every engineer knows that you cannot run a bypass forever. Eventually, the main line has to be fixed, or the whole plant explodes. The data points we have analyzed from the empty salt caverns in Texas to the debt ledgers in Caracas are all converging on a single inevitable conclusion that most people are too afraid to voice. We are not solving the energy crisis. We are merely delaying the impact. And when the bill finally comes due, it will not be paid in dollars. It will be paid in a currency much more tangible and devastating to the average citizen. The final verdict on this experiment is not written in the history books, yet it is being written right now in the algorithmic trading bots and the strategic war rooms. And what they are predicting for the next phase should terrify anyone who is still betting on a soft landing. We have traced the molecules from the depleted salt caverns of Louisiana to the rusty loading docks of Venezuela, and we have followed the money from the desperate balance sheets of American oil majors to the opaque ledgers of the Treasury Department. Now that the evidence is laid out on the table, it is time to deliver the verdict on this investigation. What we are witnessing with the Gray Channel is not a triumph of diplomacy, nor is it a blunder of foreign policy. It is something far more calculated and far more terrifying. It is an illusion of control. Washington has successfully pulled off a short-term hack of the inflation metrics by swapping strategic security for immediate price stability. By plugging the Venezuelan supply back into the Gulf Coast refineries, they have managed to keep the price of diesel from exploding, and they have bought the Federal Reserve a few more months of breathing room to navigate their interest rate policies. To the average voter, looking at the gas pump today, the system appears functional and the crisis appears averted. But this is a victory only in the same way that painting over a structural crack in a dam is a victory. It improves the aesthetics while the water pressure continues to build behind the wall. The uncomfortable truth is that the United States is merely retrofitting an old valve onto a decaying system because it has run out of new options. This brings us to the concept of the infinite game. In game theory, a finite game has a clear beginning and end, with winners and losers. But the game of managing a global reserve currency backed by debt is an infinite game where the only objective is to keep playing, to keep the music playing one more day. The fundamental conflict of our time is the race between the ability of central banks to print fiat currency and the ability of the physical world to yield cheap energy. For 40 years, we enjoyed a deflationary dividend, where technology and globalization made resources cheaper, allowing us to expand our debt bubbles without consequence. That era is over. We are entering a phase where the geology is fighting back. The phenomenon known as peak shale is real, not in the sense that we are running out of oil, but in the sense that the cheap, easy oil has already been drilled. The wells in the Permian Basin are getting gassier and depleting faster, forcing producers to drill more just to stay in the same place. This is the Red Queen syndrome, and it means the US can no longer act as the swing producer that dictates global prices. At the same time, the OPEC alliance is tightening its grip, refusing to subsidize Western inflation with their finite resources. Caught in this pincer movement between geological exhaustion at home and geopolitical hostility abroad, the United States has no choice but to abandon its moral high ground. This is why the handshake with Venezuela was inevitable. In the infinite game of dollar survival ethics are a luxury that a debtor nation cannot afford. We are forced to partner with anyone, regardless of their political ideology, who can provide the physical molecules necessary to keep the diesel flowing and the supermarket shelves stocked. This leads us to a radical conclusion about the future. We are told constantly that we are on the verge of a green energy transition, a utopian future of wind and solar that will render oil obsolete. But look at the actions, not the words. If we were truly transitioning away from fossil fuels, would the most powerful government on earth be bending over backwards to rehabilitate a crumbling, heavy crude industry in the Caribbean? Would we be risking our diplomatic reputation to secure access to the dirtiest type of oil on the planet? The existence of License 44 proves that the transition is a myth, or at best, a distant dream. The reality is that we are reverting to the 19th century style of resource acquisition. We are entering an era of neo-mercantilism, where nations will scramble for energy security, using every tool at their disposal, from legal loopholes to gunboat diplomacy. The Gray Channel is not an anomaly. It is the prototype for the next decade. We will see more of these shadow deals, more strange bedfellows, and more hypocrisy as the desperation for energy density overrides political dogma. The implications for you are profound. The stability you see in the markets today is artificial, manufactured by temporary patches, like the one we just analyzed. The system is prioritizing the suppression of volatility over the resolution of structural problems. This means that when the volatility finally breaks through, and it will when the Venezuelan infrastructure fails, or when the geopolitical cost becomes too high, the correction will be violent. We are not moving toward a soft landing. We are moving toward a thermodynamic reality check. The government has played its hand, revealing that it will sacrifice long-term security for short-term liquidity. This investigation was never just about oil. It was about seeing the strings that move the puppets. You now possess the map to the labyrinth. You understand that the official narrative is a screen designed to keep you passive, while the real assets are moved in the dark. This channel does not exist to comfort you with lies. It exists to arm you with the data you need to survive the inevitable reset. If you refuse to be a casualty of their infinite game, and if you are ready to protect your legacy by understanding the physical laws of money rather than the empty promises of politicians, then you know what to do. Share this intelligence with those who are still asleep, because in a world of manufactured illusions, clarity is the only asset that cannot be devalued. Oil is black, but the truth about it is always transparent. The problem is whether you dare to look at it. I am Elias Thorne. End of record.